Here we go. My name is Genevieve LeMarchal, and I am the Managing Director of Healthcare Ventures for ExpertDojo. ExpertDojo is, we didn't go super in depth on this, but we are a venture capital fund, early stage, but also we are a growth program. So that does color a lot of where I am coming from in terms of how I think about things. However, from the standpoint of venture capital, I try to keep this more broad and general in terms of early stage venture capital and not specific really to necessarily ExpertDojo's structure and thesis for how we invest. So if you have any questions, I've got my chat box here open. Feel free to pop questions into the chat. I may be able to answer them while we're going, or I might, save them towards the end when we have time for Q&A. As Precious mentioned, I have had, I've been in venture capital for several years, and I have worked in both, deep tech and new science, life sciences, healthcare, as well as just sort of general technology, consumer brands and products. I actually recently moved into the healthcare space from more of a generalist, I would say, but I've always been early stage. And I've always been very involved with entrepreneurs sort of from the ideation stage. I myself have also been a serial entrepreneur. I've probably had, 6 or 7 different companies that I was either involved in or the founder of, and varying levels of success over maybe the last 15 years, I would say. So I'm really excited to just talk a little bit about and be very frank in many ways about venture capital. There is a big gap, as you all probably know, between when you are in that non-dilutive funding stage, where you are, for lack of a better term, in the lab, and then moving through that process of commercialization and getting to a stage where you're ready for equity funding and how that might look. I think you guys might have had some conversations already maybe about funding, and we can talk a little bit more about that. There's different types of funders for different stages and different strategies and all of that, but I wanted to just keep this very general in terms of my experiences working with like labs market companies. So and I've got some notes here. So basically, just in a nutshell, VCs are first and foremost, we're looking for actually 2 things. So of course we have to have companies that are going to produce a big return for us, because we, that's our job. And if we're not producing good returns for our investors, there's not a lot of opportunities for you to continue your career as a VC. There's not a lot of jobs for VC fund managers of mediocre funds. So we're looking for really great returns, but we all are making emotional decisions. Every single person actually on the planet, we could talk about that another time, but makes emotional decisions, and investors especially are emotional decision makers. And so we're looking for things that really pique our interest, inspire us, and are sort of like, wow, that's a big problem. I had no idea that existed, and why hasn't anyone solved this yet? Hair on fire. And so we are looking for those things because we're kind of like, oh, look, a squirrel. We see so many pitches all day long from in every way you can think of. I get pitches coming in through my LinkedIn inbox. I get pitches coming into my email inbox. I get introductions. I meet people places and they want to tell me about their company. It's all day, every day, pitch. And so after a while, even though I absolutely love entrepreneurs and I am an entrepreneur myself, everyone starts to sound the same. And so you've got to stand out. And the way to do that is to basically, pique my attention, or the attention of an investor that says, wow, I should actually pay attention to this one, because this one is something really special. So it starts with that big, interesting and inspiring story, which oftentimes people who are coming from research, or you're engineers, or you are maybe clinicians, you're extremely brilliant, but you're not necessarily a marketer or a salesperson who's learned how to tell the story in the way that's going to inspire and evoke emotion. And that is something that becomes extremely important when you hit this gap between your non-dilutive funding stage and moving into equity funding stage to be able to tell this story. A great story will translate to a good valuation in many ways, especially with science, because you're oftentimes not able to get that sales traction. So it's got to come down to the vision and the story, how you're telling it, where you're telling that story. So one of the other things I wanted to give you guys in terms of an understanding for context is the better your story is in terms of the hair on fire problem, you're going to create FOMO in me, fear of missing out. If I believe that I might pass on one of the hottest companies that I'm going to kick myself later for not having invested in or gotten involved in, I'm in trouble. And I keep a deal flow pipeline and, track all the deals, and I make extensive notes for why I pass on a company if I'm saying no, because I am actually scared of having to defend myself later when something turns out to be amazing and I missed it, which will inevitably happen. And I'm trying to make sure that I can explain that I did give that entrepreneur the time of day, and for whatever reason it was a pass for us, and that I still did do my job. The other thing that comes across very, very commonly, and you'll see down here it says fundable. When I am working with engineers and when I'm working with companies that are coming out of research, you're commonly trained to make assertions about what is known and what is measurable. And that is not really what finance is. Finance is forward-looking statements about the possibilities of a financial future for a company in many ways. And while they're based on evidence of history, often it's still guesses. And so I see a lot of companies that are coming in with these incredible ideas, and then we get to the financial slide and they're presenting a very small business from a financial standpoint. Most VCs are not going to take the time to dig in with you and say, I think you have a business that's bigger than what you're presenting. They're just going to see that and say, this is too small, and they'll brush you off. So that's a change in your thinking and a change in your mindset that can feel very wrong for many people who are engineers and who come from that background where they're very used to research and validating every assumption because it feels unrealistic sometimes to be able to show what is possible for this company if it is to receive the funding in the way that it needs it. And so that's something that I would challenge you to know going in as you're getting ready for this process, that you've got to be able to present that financial picture in a way that's going to be interesting to venture capital. As a joke, I'll sometimes tell founders, they'll show me their hockey stick and I'll say, my buddy's car dealership makes more money than this. And it's usually sort of like a wake up call. So that's, and I wouldn't, another thing as a sidebar is when you meet with an investor or a venture capitalist, whether it's an angel or someone, they're going to push your buttons, and you should take that as a good thing. If I don't like you, I'm not going to mentally engage much in what it is that you're doing, because I have so many things in my brain, as you all do. You only have so many ways that you can use your brain in a day. And if someone's pitching you a company or an idea that you don't like, or you don't care about, or you don't like the person or whatever, you're just going to kind of disengage. But if they're engaging with you and if they're challenging you, they may sometimes come across as abrasive, and they may sometimes say things that you don't really want to hear, but that is because they like you. So I can personally say I will not push on an entrepreneur if I don't like him. If I like him, then I'm going to be challenging you. And I will oftentimes have people kind of get a little mad, and then they'll come back the next week and they'll say, I thought about what you said and you were right. And I'm like, I know, can we talk now? So that's basically, one of the things I want to put is don't get angry. Um, don't get angry with VCs or investors for pushing on you unless they're jerks, and then they're jerks. But and that exists too. Um, so the dirty secret that I want to share is most companies that are coming out of programs and incubators are not VC fundable. And I often see over and over and over and over again a trend where they need at least 3 to 6 months still of very focused consulting, coaching, and mentorship in order to get to a point where they can talk to an early stage funder. And so when it's not a smooth transition oftentimes from what I might see as a university incubator into a VC pipeline, there's usually sort of a gap. And that gap is where it's extremely important for you to find a really good mentor. And at that point, I would start to consider people who are outside of your core environment in academia, who can start to bring in. So start talking with maybe people who are investment bankers just to get their perspective about the future acquisition path. Chat with people who specialize in who have been entrepreneurs in what you're doing and have had exits and have had success. Talk with people who do a lot of deals, someone like myself or anyone on my team who sees a lot of deals and can fill in some of the gaps in what we're seeing, because venture capital is oftentimes, you can think of it a lot like real estate. There's different markets and different prices, and we'll often ask each other, what are you seeing for valuations right now? And like, what kind of companies are coming through your pipe? And it's almost kind of like saying what neighborhoods are hot and, what's the up and coming, spot to buy a place. And people will say, oh, people are buying over here. And you're like, really? And so VC is very much the same. Lawyers will oftentimes ask me this stuff, and it's because it changes. And that's why you need to start getting inputs from lots of different places as you prepare yourself for equity funding. So then this also helps to start to step out of your like academia bubble as you start to translate your science and technology story into an investment story, because you need to start to see how you are explaining and discussing what you're doing and what's possible isn't landing. And it's going to land with your peers because they get it. And so it becomes a little of an echo chamber sometimes with storytelling, where that's where it becomes really important to start to step out. So, for example, myself, as well as one of our partners, Charlotte, we will oftentimes go into OHSU and help start to give feedback and craft the pitches, even though they have EIRs, entrepreneurs in residence and house, and they have extremely brilliant people. They just need someone to come in from the outside, because it becomes an environment that is a little bit of an echo chamber. Oh, I forgot to put these screenshots in. I wanted to show you guys some examples, and maybe I'll do that in Q&A, but of companies that had come out of sort of incubatory programs, but were presenting themselves in such a way that they were definitely not ready. And I'll actually just bring those decks up maybe when we do Q&A. But the other thing I wanted to talk about is, as you guys are transitioning from becoming, what would be, for lack of a better term, a project-based business and a project lead in your business, and turning yourselves into scalable, potentially, large, multi-$100 million companies, hopefully. You're going to start to have to learn how to have conversations with lots of different people. And some of those conversations are going to have to be with people who are extremely wealthy individuals who are controlling a lot of money. And one of the things that I've discovered as in my time is the further up the chain that I go in terms of working with investors and with institutionals and with limited partners, the more I find that our conversation starts to have an undertone or become about something I call convergence. So I think what convergence is how is what this person is doing or this startup is doing going to affect the big picture of the world, as well as my life and what I'm interested in. So I'm really not interested in putting a lot of effort into relationships that are going to be a tit for tat transaction. yes, all those boxes need to be checked. Like we need to be able to hit our returns and we need to be able to make money and all this stuff. But I start looking at how is this going to benefit everybody? How does this make so much sense? And it can't just be, yeah, it's going to have an exit and it's going to make some money. It's got to be more than that. And that is where it becomes very, very important to start to get to know investors ahead of time and build relationships, because you'll start to find those areas where their involvement and their investment makes so much sense, not just from a monetary and return standpoint, but from a standpoint of what it is that they're looking to achieve or create or leave as a legacy, who they want to be, who they want to be seen as, and how they want to engage with the world. So when you start having those conversations, you build an entirely new relationship with investors that actually makes you very, very, very powerful. And so I wanted to make sure we talked about this because I think that oftentimes these how to raise venture capital presentations are so tactical. Make a deck and get your financials and make sure the hockey stick goes like that, and all those things. But at the end of the day, if you're working with really sophisticated investors, this is what people are often looking for. You know what I mean? So, what I've got one company I was meeting with this morning, and one of the things that I really like about this founder, aside from the fact that I just like him, he seems very genuine and very salt of the earth. I like that he is has bootstrapped and a lot of these different things. But he seems to be somebody who really is very community oriented, and that he wants to give back and participate in a community of entrepreneurs. And he wants to create something bigger than himself, and he wants to make people a part of that. So I start thinking about that, and it makes me more interested in investing in him, because I'm like, if I invest in him and help him be successful, he is subsequently going to help me be successful, because he has this desire to empower and tilt up people, and so do I, and he can help me in my endeavors to tilt up people, and here we go. And so I'm starting to see something that's more than just a tit for tat. One of the things too that I wanted to discuss here is some of the misconceptions and the errors. So one of them is, most entrepreneurs I talk about, when they start talking about when they're running out of runway and how quickly they're burning, and then they say how much money they need, and I talk to them about where they're at, they are 2 to 3 months behind already. And that's kind of scary, having seen so many companies, and I can almost kind of see their future path. And I'm like, oh no, this is not good. And it's because they weren't having those conversations. They were not starting to have the casual conversations with investors and with funders about what they're creating. They're waiting until it's perfect, until they've got the perfect pitch deck. And, when they're ready to emerge from, their lab, or, wherever they're at, as, the butterfly, and they're like, I can't go out, I'm a caterpillar still. And it's like, nope, you got to talk to people while you're still a caterpillar. Otherwise, and this is where convergence becomes so important, because the time frame to raise your money is going to take you so much longer than you thought. And there's going to be much more moving pieces than you often believe that there is. And it's just, you're going to have to talk to way more people. And this is something that I see time and time again with entrepreneurs, where they drastically don't have a handle on the timeline that it's going to take. So one of the things I commonly hear that just shoots people in the foot is they'll talk with a VC, and that VC will say, oh, our typical check size is about, 500,000, let's say. And that entrepreneur thinks in their head, oh, well, I'm raising 500,000. So this VC could just take the whole round. They seem really interested, and they seem da, 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 da. A VC will not take your whole round. So what that actually means is you're fundamentally misaligned. It doesn't mean they're not interested, but they're not going to invest in this round. They are going to continue to get to know you and continue to track on what it is that you're doing. And they likely want to get into the subsequent round with their $500,000 check when you're raising closer to 2 million. And the reason for that is because it's too risky oftentimes for us to take down an entire round. It's not to say we can't, but that's not the usual model. And so I have seen a lot of entrepreneurs kind of put all their eggs into one or a couple baskets, thinking something is going to be the case when it is not, in fact, the case. Or they believe an investor is more interested than they really are, or they think that the investor is moving faster than that investor really is. And so those are things that really shoot people in the foot. The other thing that's really important that oftentimes I think, especially new entrepreneurs, are very reticent is to ask questions of investors to make sure that you're a right fit. What terms do you typically like to invest on? What check sizes do you typically like to write? How many deals have you done? And, when was the last one you did? And how many per year? And, these are all just part of a conversation that should be had between two potential business colleagues. And entrepreneurs are oftentimes afraid to ask. And I think that I can see why there would be some fear and some hesitation. I think it gets a little hyped up in our brains, like, oh, I want to hold my cards close and negotiate. It's better to just ask up front, and they can, if they don't want to share that information, they'll be vague or they'll give you a range. But good investors will share that information. They will tell you exactly, here's what we look for, here's what we don't do, here's why, and now if this is someone who makes sense for you. So make sure you ask. Another thing that I commonly see with startups that are science-based or coming out of the lab, heavy engineering, is large amounts of money being raised in a single go in order to get 18 months of runway. And that's not always going to happen. Sometimes it's better and just more feasible and more possible for you to raise smaller amounts over time. And that's where a good strategy comes into place. And that's where really, really good mentors and advisors can help you lay that strategy out in a way that's very sound. And this is when you're going to start getting busy, because now you have two jobs. You need to work on the fundraising, and then you need to actually work on your company. So this is where you're going to start feeling a lot of friction. And there's also going to be a lot of chicken or egg conundrums that will occur around here. And then another thing that you guys probably run into is being, sort of peddled or told to do lean startup stuff in your companies. And that doesn't always work. In fact, it never usually ever works with companies that have core science, core IP, deep technology engineering. So I would say that's why it's important to ask investors about their experiences and to try to stay away from investors who are very naive, because they can actually hurt your business. Sometimes a check is just a check, and sometimes a check is probably one of the worst things you've ever done. So yeah, from that standpoint, get a good advisor. They are just absolutely worth gold. Find someone who has done what you've done before, who's done it recently, and who has, even just a couple minutes a week to chat with this person and touch base can really help you. So I highly recommend a good advisor. I work with, I think I mentioned before, Charlotte Triplett. She is advising many companies that are in pipe for me, getting them ready, because they're just going to be that much stronger of an investment when we're able to do it. And I can give her the direct guidance on here's where they're lacking and here's what's missing. And once they have these things, we could move them forward. And she knows how to navigate that landscape, and that's that. Let me check. I've got some notes here, but we can probably go into some of this stuff too in our Q&A. Do you guys have any questions for me?
It looks like, well, there was, I think, one question in the chat just about being able to get a copy of your presentation, which has been really great, Genevieve. Thank you.
Sure. Yeah, of course.
I'll just let everyone know in the group that will go out after the presentation, along with the video and the transcript of the chat. And I want to mention quickly that you can use the chat. You should be using the chat to network with each other. We have a nice big group here. There might be some really great people for you to start early relationships with, just like Genevieve mentioned, early, and maintain those. So please introduce yourself in the chat, LinkedIn bio, you name it. And it looks like maybe Sarah has. And I know Precious, I'm sorry. I don't know how to not work. Sorry.
No worries, RC. Thanks, RC. I see. Let's take the first question from Sarah. Sarah, I see your hand up.
Hi. Hi, Genevieve. Thank you so much for this presentation. It's super informative. I'm advising a Viterbi startup right now, and they're exactly in this space right now, trying to figure out how they can get funding to expand, scale, etc. From their sort of earlier sort of 1-year pilot concept. I'm just kind of curious. You mentioned the early stage funder, and you kind of had a sort of timeline of like how these sort of school incubated sort of projects need at least 3 to 6 months before the early stage founders are interested in their concept. And I'm just kind of curious, what else, what are some of the criteria they may be looking for so that early stage funders would be interested in them even further?
Yeah, well, so I could drill in on the company and what are they doing, the market, all that. But in general, I'm thinking about milestones and stages. And so let's say, for example, it is a medical device, let's just say. I need to know, how much money do you need now that gets you to what stage? And then the question I'm asking is, and at that stage, has your valuation increased enough to the point where we can raise more money if needed, or what that might be, in order to get you to the next stage? So what I'm trying to avoid as a VC is something called a flat round or a down round. And so if I give you $1 million, let's say, and that doesn't get you far enough, and let's say I give you $1 million on a $10 million valuation, and then in 1 year you need another $1 million, but you haven't made substantive enough progress to increase your valuation, I have to invest on a $10 million valuation again or less. And that's not good for anyone. Investors hate that. It's really bad for founders, because that's your stock that you're giving up because you're not expanding the pie. It's not a bigger pie. So, the question is, how much money gets you to where, and is that pie substantially big enough at that point that it makes sense? So if it's getting you into market, let's say, then the question is, then how much traction do we need in order to get you, when are you cash flow positive, and how much is that going to take? And so I'm sort of thinking, I'm like constructing this web of potentials, while you're talking, and I'm asking questions about your compliance and your regulatory, and then manufacturing and IP. And I'm looking for, at what points are the potential trains going to speed in and hit you, and will you have enough cash? And so that's basically, it's like a quick analysis that we're doing when we're asking those questions. And so before you approach a VC or an investor, you need to be able to sort of lay that out. So also, I am obligated to continue to participate. So I need to know, if this train is leaving the station at 5 o'clock, where's the next station and that stops, and how much are you raising? Because I'm trying to think about, and what am I going to need to pony up in that round to continue forward with you? Not all investors can or will, but VCs are somewhat obligated to, and our funds are designed and structured in such a way to do so. So we're planning on it, and as your funding partners, it's the right thing to do to continue to back you if you're doing well. Does that make sense?
Yes, thank you.
Thank you, Genevieve. That was a great question, Sarah. Thank you. And fantastic information that Genevieve was giving us here. Naveed, I see that you have your hand raised. Would you like to pose a question?
Yeah, sure. Pretty much in the same line, that what is the best timing to approach a VC
Mhm.
not too early or maybe not too late? That's I'm trying to understand that in terms of
Well,
timing.
too early is okay as long as you're not making a pitch and trying to get money when you're too early. You know, you can start to build a relationship with people, and start to get to know people and share what you're doing. You know, if anyone reaches out to me and says, hey, we're not raising, but I really like your fund and I am interested in maybe working with you and I want to share about my company with you, I'm happy to look at it. I'll put them in the pipe. I'll keep track of them. I'll pay attention. And then when they come around and say, I've met these milestones and I'd like to, maybe have a conversation with you about what it might look like to move forward into funding conversations, I'm happy to do that. So don't pitch too early. Don't try to get money too early, because then you just kind of look naive, but build relationships, I think, is fine. Then the other standpoint is timing wise, you need to go out to raise that money once it's going to go towards, in general, this is not always the case with like therapeutics and medical devices, but in general, the money needs to go towards growth. So you may, of course, have product roadmap you're still working towards, and you may still have a lot of things that need to be done on the product, but a good portion of the money that you're raising needs to be going towards growth. Otherwise, there's other sources of capital that are probably more efficient. Venture capital is extremely expensive. So, you want to leverage our dollars towards increasing your company's value, not put our dollars towards operations or things like that as much as possible.
Fantastic advice. Thank you, Genevieve. And thanks, Naveed, for the question. Let's go with Arturo.
Hi, thank you. It's a pleasure, Genevieve. Thank you for the presentation. To jump on that same topic that you just replied on and ask a follow-up question, if most of the money is going into growth, that means that there has to be some sort of traction already that has to be shown. Is that correct? And what does that traction look like ideally? And that sort of tells you that this is something good to jump on.
Yeah. So once you've got that, some decks you might see will have like a slide about what they want to raise, and they'll say sources and uses. And it'll say, oh, this much is going to go to overhead, and this is going to go to dev, and then the rest is going to be growth. Growth, if you are not actually ready to yet sell, or if you're getting there, can mean like establishing KOLs, knowledge and opinion leaders. It can mean getting letters of intent that are in place. You could say, we've got 5 different letters of intent, and we really want to have 10 in and signed by the time we go to market, and this will help us get that. So one example is one of my companies in my portfolio is a VR, or it's augmented reality for construction. And so really, really, really strong core tech, very, very, very technically sound team. And selling into construction is a long, long, long pipeline. And so for them to grow, it's basically just getting more companies into the pipe, but it's not, or projects like construction projects. It's not necessarily though about them booking that revenue. But I'm an early stage investor, and we all have different varying levels of risk. So there's a lot of investors who don't want to invest in that one yet because they want to see some of these companies turn from pipeline into paying clients, which is totally understandable. And that's where chicken and egg comes in. Other ways that you can grow if you are like healthcare or research-based is starting to do publications, starting to speak, going to conferences, and really talking about, what it is that you've created with the people who would be buying it. And I also highly recommend for certain companies, especially, to start to branch your conversation outside of academia and start talking about how do you get the general public excited about what it is that you've created as well? What's the potential for society or for, people who aren't sitting in a conference room listening to you present on stage, that's ways to grow. But ultimately, at the end of the day, it's going to be about getting someone to pay you money for the thing that you create. So.
Got it. Thank you.
Thanks, Arturo. It looks like we have a question in chat from Peter. Peter would like to know, it's a related question. What's the best way to stay engaged with investors who say you're too early, but keep us posted as things progress?
There's plenty of ways to do it. A lot of companies will just start sending out a, monthly or quarterly email update. They'll share, one company that I've worked with in the past was called Biomodem. It was a smart robotic exoskeleton. They were doing some really cool videos. And so I love to see videos of, a kid with cerebral palsy walking with the prototype. It's cool, and it's very engaging and interesting. I show my friends like, hey, look at this, and so that's fun. And then the same thing with the VR company or AR Argyle, they will send videos out so people can kind of see what it is that they're actually doing. So there's a lot of different ways to stay engaged. Think of it as if it's like your parents want to know what you're up to, but your parents actually know what you do. Like what, if you were like going to tell your dad, like, hey dad, look what we did this month, that sort of thing. If your dad knew what you were doing, my parents don't understand what I do. So.
Thanks, Genevieve. I have a question. You had a slide, I think, starting to talk about this, but can you talk more about examples of companies that were transitioning out of an incubator, but not necessarily VC fundable yet?
Mm-hmm. Yeah. So actually, that was one of the decks I was going to show you guys. I think I've got a couple members of my team on here, so you guys don't tell Biotesseray that we're going to use them as an example. But I love this company, but their deck is horrible. Okay, so this company had come out of, I think they went through iCore. So they had a lot of experience doing a lot of customer interviews and things like that. It's a nanobodies platform therapy. So it's a targeted immunotherapy, and their first drug is going to be to treat canine cancer. So this is their deck. Their company is called Biotesseray Community. So I was very confused when I first got this because I was like, what is this? Again, like if you open this, you wouldn't know that this is a drug using nanobodies to treat canine cancer. This is their logo. Okay.
Yikes.
Yeah. And then third slide, now we get into discussions about canine cancer therapy, and so we're kind of scrolling through here and I'm starting to see like, oh, there is something in fact here, but it really doesn't look like it. Most VCs would just throw this away. Like it wouldn't even make it in through the funnel. There's pictures of llamas, which doesn't have anything to do. Cameloids, yes, and I think the point they were trying to make is this company is, you'll notice it's in Corvallis, Oregon. They're uniquely positioned to be able to do this work on nanobodies because they have access to this cameloid research lab that not many universities have. But that doesn't really come across very well. So then they're talking about nanobody platforms, and then they very quickly went in their conversation into talking about how this is basically going to be a human cancer drug. And I was like, whoa, like, oh my gosh, I'm here to talk about dogs. Can we talk about dogs? And so they started basically talking about the whole big picture that sort of right out the gate, which that's too much. You've got to talk about, I'm sure some of you guys have heard about the beachhead strategy. We're going to start with this market. This market is this big. It's going to be great. Then we're going to do this. And so don't say, we're going to Mars when you still are in a cardboard box in your front yard, drawing flames on your cardboard box rocket ship, So then the team here, I had a hard time understanding if this was a company or if this was an academic project. It's not clear to me what roles are. It just shows there's a lot of contributors, and I see that a lot in decks, and I understand there's going to be a lot of advisors and a lot of contributors, and I start to wonder, is this a business? If we give them money, will it go somewhere, or are we funding an academic project and they should be just continuing forward with non-dilutive? Then they give me this regulatory thing. And I don't understand what this means at all, but people in academia do. But I was able to figure out, oh, you're trying to tell me that getting the USDA clearance is easier than getting the FDA clearance, but all you're doing here is scaring me with this FDA thing, but this wouldn't scare somebody who's one of their peers, but it confuses me. And then, all of this. And so as you can see, like, this deck isn't really probably selling any of us. But when I actually think about the potential to have a Sarah McLachlan commercial where we're selling a canine cancer drug, I think that commercial made $37 million, I read. So, this becomes very interesting. And from a standpoint of convergence and resonance, I am a Bernese Mountain Dog lover. They routinely die very early of cancer. And I have been brokenhearted for many years of my dogs dying. So I'm very, very, very interested in seeing this come to fruition, because selfishly, I want to own a Bernese Mountain Dog and be able to treat it for cancer. So there's that, and so that would have also been something where maybe had we gotten to know each other a little bit, because all of a sudden now I'm texting them pictures of Max, I'm telling them story, and now we have something that is, that we can resonate on. But, you can see here, this deck is really not a investment deck. This timeline and milestones tells me nothing. And it's this specific slide here that they need to go do about 3 months of work. And, I've given them some engineers and some people to kind of help them map that path forward, because they couldn't answer the question of how much money now gets you through the USDA, and then how much money do you need to raise to get into manufacturing, and then what happens from there. And so, they were saying, here's the shiny train, it's going to leave the station. And I'm like, where's it going? And they're like, somewhere. Like, okay, yeah, so we need to figure out where the train's going the next couple stops at least. So this is an example of a company that's highly validated research, science, and market need, not ready for venture funding.
Thank you for sharing that. Super helpful.
Mm-hmm.
Okay, I think we have time for another question. I see RC raised her hand, but I'm going to take this question in chat first. If you have a lot of IP and still working on your patents, but have a large company that wants to see your prototype, would you try and get them to sign an NDA? If they said no, how would you approach this?
I think you should get some advising right now before you go talk to them. I highly recommend, I don't know if you have, I'm sure you have some great IP lawyers who have helped you file those patents. I would recommend you talk with an IP portfolio strategist. They're harder to find. You guys might have some people there. I've got a couple people too who are really, really, really good, depending on what it is you're doing. IP portfolio strategy is very different than IP lawyering. I would have a discussion with an IP portfolio strategist, and then get about, because it's not just about the patents you have, and it's not just about, it's about the entire competitive landscape that surrounds the patents that you have that maybe you haven't even necessarily thought about. And then it's about exactly how you worded your disclosures, your descriptions, and your prior art. And it's as much about what you've patented as it is about what you didn't patent. What you didn't patent is sometimes even more important, the trade secret. And so I would highly recommend that you do that first, and then that's IP. They'll advise you on how to have that conversation, what to disclose, what not to disclose, and how to move forward with it. And then subsequently from there, if you need an NDA, I would make sure that it's not like a one-way NDA, that it's, it's a mutual NDA, and, like we'll have discussions from there. VCs will never sign an NDA, by the way. So just don't disclose anything that is of risk until, and don't ask them to, because it's kind of bad form. Just don't disclose stuff, but yeah, I'm not sure who the company is or what it is, but you've got to be really careful. There are a lot of companies that are basically just, their intellectual property teams will steamroll you. And there's a lot of companies that I have passed on because at the end of the day, I looked at who their competitor was, and I was like, I think that you're just going to get killed by 3M. There's really nothing we can do about it, and it's unfair. It sucks, but that's why I would work with a patent strategist before you go have that conversation.
Super important advice from Genevieve there. Okay, so RC, last question.
Yeah, it actually has to do with kind of what you were sharing with us from the deck, from the very academic startup. And, we're a tech incubator. We do get a lot of research being translated into a marketable business. And I think that one of the things we talk about often is kind of how you mentioned that, VCs make emotional decisions, and so much of your time with them and your deck should be storytelling. And obviously, for instance, the team that you showed us lost their opportunity to trigger you emotionally. They wouldn't have known you had a dog, but had they had a better version of what they were doing told in a story that was compelling and emotional, you would have had a completely different response and would probably have better feelings about them as founders in general, which, so many VCs say they bet on the jockey and not the horse. And so I'm just wondering, for, tech teams or engineering teams who aren't in the business of telling stories and being super emotional about their research in that way, what resources could you point them towards, whether it's books or anything really, for them to use to kind of help them to bridge that gap between the real hard science of what they're doing and the emotional storytelling that they're missing when they go fundraising?
Yeah. I'm trying to think about a book. There's a few. I might have to email you, but one of the best ways to think about it is this. Who is the big, hairy, awful enemy that you are fighting? It's not you have a better feature set. It's not that your product is, more scalable and easier, cheaper to manufacture. It's not that. It's like, so when you think about, let's make this really simple. Clean beauty. So makeup, skincare, lotion, whatever, that doesn't have chemicals in it that cause, endocrine disruption and cancer and all that horrible stuff. They're not out there trying to necessarily say that our products don't have chemicals such as these. They have better chemicals such as these, it might say that on the bottle, but their big story is, Unilever and Johnson & Johnson and all those companies don't care about your babies. They are poisoning you. And they're putting things in the products that are disrupting your endocrine system. They don't care because they're big, awful companies, and we care. And so we have taken out all of those horrible products from ours, and we're actually putting good stuff in that helps your babies and, and all these things. And they're getting people to be like, oh my God, I can't believe Johnson & Johnson would do that. Those, and so in a way, that's sort of the way that you need to think about what you're doing is, what is the thing that you're combating? What's the thing that is so horrible out there in the world that should not be existing, but is? And what are you doing? Everyone loves a David and Goliath, underdog story. You are the underdog. You are the champion. You are going out there like guns blazing, arms swinging, throwing rocks at the mutual enemy. Who is that mutual enemy? And why are they so bad? And that is, I think, one of the ways to start to evoke that emotional reaction when people say, this is an injustice in society and it is not there. And we need to fix this. I can't believe this is allowed to happen. This is not, and I'm such a sure thing when people sell to me in that, I find out like, oh, there's this, disease that has no diagnostic and people walk around and they spread it. Oh my God. And now I'm like telling people at the 7-Eleven, did you know that this is happening? And that's how you start to create, I have to be an evangelist for my companies. I'm pitching them, I'm raising money for them, I'm doing all this stuff. But when people start to get on your bandwagon, they want to pick up a rock or a pitchfork and fight with you. And that is how you create that emotional connection.
Thank
Without
you.
cute puppies and kitties and cereal.
Right.
That'll work too.
That's a really important question, RC. There's a video that we use in our national I-Core cohorts when we get to the storytelling part of the curriculum. So when we distribute Genevieve's slide deck and the recording of this, I'll include the link to that video. It's super, it's a quick video, but it's super helpful and it kind of wraps all of that up. So with that, I want to thank Genevieve for her time. Thank you so much. This was wonderful. And I will be sure, like I said, to distribute everything to everyone after this. Oh, wait. Oh no, I thought we had more people raising hands. Let's just round of applause for Genevieve. So thank you again.
Thank you.
We hope that you'll be able to come and join us at another point in time and connect with our students. Thanks so much.
Absolutely. Yeah.
And everyone for joining us. We had a nice turnout today.
Great. Well, thank you guys so much. And, if you have any more questions, I'll send the deck out, but, y'all know where to find me.
Thank you, Genevieve.
Yeah. All right. Bye.
Bye-bye.